Magic. Welcome, everybody. This is the sixth in the Ku-ring-gai Council Impact webinar program as part of the New South Wales Small Business Month. Thank you so much to the New South Wales government for funding this program. My name's Will. I'll be introducing our speaker, Amy Chen, this morning, who will be talking about the big dirty money question and what you need to do to ensure that your business remains viable. So the two big things that you need to know. Amy has a long experience supporting businesses across a range of industries, and she's also a business advisor for Realise Business, who deliver the Business Connect program in Eastern Sydney. I'm not going to waste any more of your time listening to me. Just quickly, if you have any questions, put them in the Q&A box. Any observations or comments, put them in the chat box. I'll be keeping an eye on those. Amy, if you can just share your screen, that will be great. And yes, everybody enjoy. I'll see you shortly.
Okay, good morning, everyone. Thank you for joining us today. As Will mentioned, my name is Amy, and I'm one of the business advisors through the Business Connect program that's delivered through Realise Business. So for those of you who want to know a little bit about my background, I basically used to be the person who would look at a business's loan application and decide whether I wanted to lend money to you or not. And a big part of that is looking at a business's cash flow, as well as, you know, any other risks that are associated with your business. Okay, so businesses big and small, lots of industries, as Will mentioned. And I've done it here and overseas. So there's not a lot I haven't seen. So today's topic is called the two big things you have to get right when managing money in your business. Okay. Now I'm going to run through a couple of things. It's pretty hard to narrow it just to 2 points. So number one will be all about planning. So cash is king. So I'll go through the differences between profit and cash. And it sounds really obvious, but it's a matter of keeping your personal finances separate from your businesses, which can be a little bit harder when you're a small business. Now, with number one, cash before profit. Now, I'm just going to run through a scenario just to show you the difference between the way your cash flow operates, as well as profit and loss. Okay, so what we see on the screen on this case study is pretty basic. You've got 6 months worth of sales, what it's cost you, net profit at the end of the day. So what this table doesn't show you is that when you invoice your customer, it's a pretty extreme example. Customers have 2 months to pay. When you buy stock, you've got 30 days to pay for it. You needed to buy 2 months of stock up front. Your overheads or your general expenses are paid every month. Okay, so so when your accountant produces your profit and loss statement for you month on month, it'll be what you sold, what those goods cost you or services, plus what expenses you incurred during the month. There's no tie into when cash actually comes into your account and out. Now, in this same scenario, using these same assumptions, this is what the cash flow looks like. So the top table is exactly the same as you saw on the bottom page. The bottom half shows the actual cash movement in to and flow your bank through your bank account. Okay, so month one, you remember customers had 2 months to pay, so you're not actually going to get the money yet. You've got 30 days to pay for your goods, and you bought 2 months up front. So month one, that bill's not actually due, so you haven't had to pay it. Overheads are due and payable every month. So you can see month one, there's a deficit of 50,000, well, 50, I rounded it up. So $50,000. Okay, so that's month one. Month two is when it gets interesting. So customers had 2 months to pay. So of course, the money that they owe you hasn't come in yet, but you had to pay for your goods because you only had 30-day terms. You had to buy 2 months worth of goods up front, which is why there's 420 there. So it's basically month one, month two of your products from that top table gets paid out in month 2. Again, overheads every month. Now, month 3, and it goes on. So what you sold in month 1, that money actually lands into your account in month 3. Same with the goods, it carries forward. So it's meant to be 240 and so on. So what I want you to actually look at is this the very bottom line, where month 2, there's a deficit of about 470,000. Now, the idea of planning your cash is to make sure you've got enough resources to cover that deficit at the bottom, because when you look at your P&L, it looks like you're going to be positive the whole time. So I guess that's a really quick and dirty explanation of the differences between your cash flow and what your profit is. Even very, very highly profitable companies can go bust because there's no cash in the bank to pay their bills. Now, this is a pretty, well, it's not very aesthetically pleasing, but it does the job. This spreadsheet, this template is available from the business.gov.au website. I do have the URL on the page. It's when you think about cash planning, you're really talking about cash flow forecasting. Don't let the word forecasting sort of discourage you. It doesn't have to be a multi-20 tab model. I find a spreadsheet as simple as this enough for most businesses to manage their cash. So you just have to remember it's about when cash lands into your bank account and when it leaves the bank account. And what this shows you is when you sort of go forward in months, and you can do these by weeks, you can see what bills you've got, what bills you need to pay in a certain month. And then down the bottom shows you what your cash balance is, what the movement of cash will be in your account, and whether you'll have a closing, like a negative closing balance, which means you would have needed some sort of overdraft or some sort of loan in place to cover that shortfall. Okay, so if we go right down to the bottom line, you can see in February in this example, there's a deficit of 123,000, and that's because of there's a huge stock purchase in that month. Wages were also particularly high, you can see. Now I do encourage people to at least forecast by month, because your expenses tend to be quite lumpy. You don't pay a fixed amount for everything every single month. So if you, particularly things like GST, GST is generally payable 21 days after quarter end. So you can see the money coming out in April for the March quarter, July for the June quarter, and so on. Okay, so there should be a January one there, but I think it's a startup. I think I did this one as a startup. Other things to factor in that would factor into this cash flow is any seasonality. So if you have a summer-based business, it's going to be a lot more positive in the warmer months. And this middle section here where it's colder, you would have had a target of how much money you would have had to have built up during your busy period to cover any possible deficit when during the colder months when sales aren't as good. Okay, so it's the key is I guess the one thing is revenue, and sales generates revenue, but it's actually collecting on your invoices that creates the cash for you. If anyone's ever sort of purchased stock from overseas and had to outlay it up front, you know exactly what I mean. You've had to outlay the cash before it even comes in the door. All right, so I guess in that delightful spreadsheet I just showed you, how do you make it work for you? Okay, so because it's a spreadsheet, you can plonk any number you want into it. The key to remember with the forecast is that you do not need to be down to the dollar. It's a planning tool, and it's to see round about what your position is going to be at any given point. I will preface that by saying that do put numbers in there that kind of make sense and are kind of close to reality, because it's the old adage, garbage in, garbage out. The forecast will only ever produce information that's helpful to you the forecast is only ever going to be as useful to you as the information you put into it. The other important thing is to put in future plans. So if you've got plans to outlay for, new furniture or some sort of asset purchase where there's an outlay of cash from you directly, include that so you can see whether you can afford it in future months. And you can pick a point in time where your cash flow is stronger, where you can afford it, and it's not going to put you in jeopardy of not being able to cover your bills. A buffer of cash is usually quite handy to have because you don't know what's, unexpected stuff happens. Okay. And then the idea of the forecast is that it's a planning tool. So you look ahead. If you can see a deficit coming up in the future, it's probably a good prompt for you to do something about it now, as opposed to waiting till complete disaster. Even if you need to get like a temporary increase in your overdraft or a loan of some sort just to cover you through that period, it's a lot easier and a lot less stressful to get a loan before you actually need it, because your business looks a lot stronger. If you wait until a time where you're actually under quite a lot of stress and your cash flow is under quite a lot of stress, you're not going to have a lot of options, and you're going to end up taking the first thing that comes along. And that may be something that's really onerous, where you have to offer up lots of security and maybe really expensive in terms of the interest rates that you need to pay. Okay. All right. So 2 big things. The second is separating out personal and business. And I have to admit, I am guilty of this myself. There's a saying that cash is like gas. If it's there, it just disappears. There's no rationale to it. If it's there, it's going to be gone. So I guess particularly if you run your own business, you need to be quite honest with yourself as to whether something is personal and business. Now, at the end of the day, it's your business, your choice. No one's ever going to judge you for it. But like in terms of if you want to build value into your business, it is worth reinvesting that money into the business rather than eating at a lot of fancy restaurants that, in reality, you probably personally couldn't afford. Okay. A good way around that is working out what salary you need to work. You need to be able to live on. And it can't be too frugal. You need to be comfortable. Otherwise, you're going to be miserable. And it's a matter of sticking with that salary. So, it's not like putting coffees every day on your business account. Okay. It may mean that your business looks a lot more profitable it may mean your business is actually more profitable than you think and what appears on paper right now. And it also gives you a little bit of extra funds to reinvest in the business and grow revenues even more. Okay. Now, I find a bank account structure that is conducive to you separating out money is quite useful. Okay. So what I've got is a suggested structure. You use whatever works for you. I know personally that when I get GST collected, I need to separate it out because I think I'm richer than I am. So basically a run through. Your operating account is where all your monies for the business comes in. From that account, pay yourself a wage, and that's what you live on. And also from that operating account, it is worth separating out a little bit of money, because if it's sat in the operating account, sometimes you have a tendency to spend it. Okay. My suggestion is separate out whatever GST you've collected, payroll tax that you withheld, and any company, it's useful to accumulate and progressively over the year what company tax you think you'll end up paying, rather than being stung with a really big tax bill at the end of the year. I have something called a rainy day fund. That is basically a contingency fund that you build up over time. In theory, businesses should have a buffer of about 2 to 3 months worth of operating expenses stashed away. So, if you suffer a big an unexpected downturn in trading, if you've had to suddenly outlay for something that you weren't expecting to, or, any other kind of disaster happened, you've got enough money to get you through at least 2 to 3 months. Okay. And then number 3 is an investment / growth fund. So this is the money that you kind of save up to the side so you can reinvest in your business. Say you want to buy a new piece of machinery to increase output. So that's where that fund will assist you in growing the business and scaling up without necessarily having to take on a lot of debt to be able to do that ramp up. Okay. Now, biggest tips in terms of mastering your cash, and this goes beyond the 2, but I thought I'd put them in. So tip number 1, plan ahead. Understand the timing of the cash coming into your business and also the outflows. That includes understanding the seasonality. So what happens between, school holidays, or whether you're a weather-based business, whether you're a Christmas or a Mother's Day-based Christmas, they all exist. So it's a matter of understanding how your business fluctuates. Now, chasing up client payments is a big one, not one that many of us enjoy. At the end of the day, a sale isn't actually a sale until you collect the cash from it. Okay. Manage your bills. And what I mean by that is, use your creditor terms. Okay. If a bill's not due and payable until 30 days, then wait 30 days to pay it. It's basically using trading terms is a really cheap form of finance, if I'm honest with you. And it can give you a buffer in terms of when you're waiting for your debtors to pay you. If you have any unused assets lying around that you don't foresee using, sell them. There's no point it being sat there. You may as well monetize it. Different bank accounts and separating out personal from business. Okay, I find different bank accounts give you a little bit more discipline around, not dipping into, like, you need to quite consciously dip into another account if you want it to cover a shortfall or something. So it just gives you that extra layer of decision making. Build your rainy day fund. There's fund missing. Again, this is to protect you from unexpected events, so you don't have to scramble and try and find monies to make your payroll, for example. And don't be scared of borrowing either. Like, I find a lot of business owners are quite debt adverse, and I understand why. But often something that protects you from fluctuations, and it's a matter of knowing that you've got the cash flow and you've done the planning to know that you can repay that loan. Okay. Often there is an adage where where they say sometimes a balance sheet can be too lazy, and that's because the cost of your share capital and your directors' injections is actually more expensive than what the cost of debt is, which is basically what the interest rates are. Okay. And one parting comment is strong, consistent cash flow doesn't always happen by chance. It does take work. It does take planning. And that cash flow forecast that I showed you early on is quite key to managing that process. Okay. And that's it. That's the 2 big things that you need to know about managing cash. So if there are questions, I am more than happy to answer any queries that come through.
Thank you very much, Amy. A lot of information there in a very small amount of time. So hopefully you guys have managed to absorb at least a few of those points. So yeah, any questions, please put them in the Q&A box. Any observations, please put them in the chat box. Now, Amy, what are just in terms of while we wait for any questions, what are the most common mistakes that small businesses are making currently, do you think?
I find a lot don't. Well, I find a lot don't plan. They have they instinctually they know they're not in a great position, and I guess they don't know what to do. They don't know how bad it is, and sometimes it's not as bad as they think. Often instinct plays a really big role. in terms of, you know, how you feel about business. You can feel there's, you know, particularly under these circumstances, there is the downturn. Trading, well, most experience, not all businesses have experienced a downturn, but you know, instinctually, you know, it's not great. But it's a matter of it's a matter of knowing what you need to do, like how bad it is, and what you need to do to get yourself out of this position. And often that's the stumbling block. They don't forecasting to most people. Most people don't even like spreadsheets, right? So they don't know how to forecast out.
Okay.
And I guess once I guess a lot of the advisory sessions that I go through, we will do that very same spreadsheet that we showed, and then we can work out timing. It's like, you know, you need to apply for this now so you can cover that. XYZ needs to happen in this month so you have enough money to cover off your wages next month. So I guess it's really you need the figures in black and white in front of you to know precisely what you need to do.
Okay. And I just had a question. I was having a few questions come through. What can you do when a bank won't lend you money to expand?
Well, that depends. Well, there's a whole lot of factors that go into a loan and the purposes of a loan. Now, I worked in lending for a long time, and often any sort of it's a rash. It needs to be, the proposal needs to be rational. Now, with small business, and because it is Small Business Month, lenders often will require some sort of security. Okay. The other thing is that lenders aren't keen on lending to businesses that are less than 2 years old, because statistically, if you look at the ASIC statistics, most small businesses will fail within the first 3 years. They will not continue trading. So I don't know where that 2-year-old came from. I know it exists. So if you're a newer business, yes, you will struggle to find finance with certainly the big four. So it's a question, it's really what you do when they won't lend you money to expand. I guess it's a matter of finding out why the lender is not comfortable and what you need to do to address those areas of concern. There's often something to do with security, something to do with the usage of cash. Maybe the business is too young. So you perhaps need to get that feedback as to why. And there are non-bank options as well. They're often more expensive and they can be more onerous, but look beyond the banks as well. There's other financing options and other structures of finance to look into.
Okay. Another question here. Say if you can pull out money from your mortgage at 3.75, or borrowing at commercial rate from the bank at a higher rate will cost you more. What are the advantages of borrowing at a higher rate from the bank? Now, I know you're not this isn't a financial advisory session, Amy, but what are your thoughts on that one?
Yeah, no, I didn't have my disclaimer in this. Everything I say is general in nature, and you should, you know, talk to someone, you should talk to your own advisor for your own circumstances. In terms of pulling out money for your mortgage, well, I guess the interest is not deductible for you. You are going to foot the bill for the mortgage interest personally. Okay.
Right.
That's the biggest one that I can see. You need to do what works for you. Okay. So I'm not, lots of people do it. But the one observation I would say from that comment is that your personal mortgage interest is not a deductible interest expense, whereas a business one is. And then you've also got to look at the personal liability side. The mortgage is against your personal, my guess is residential asset. And that's your personal asset on the line. Sometimes you can separate out business loans and not have that personal liability attached versus using the mortgage.
Cool, great. Another question. Are the principles you described equally applicable to a small consulting business, say, where it's impossible to predict when the next project will turn up? Does that make sense?
Yes, it is, because that type of cash flow would be, I think it's a matter of looking at what your outlays are. Now, for a consultancy business, your fixed costs are going to be relatively low. You'd be paying for some software at a guess. a premise if you're not working from home. So it's working out the fluctuations in when I always work from the expenses first. So what do you have to outlay? Your insurance you'll need to pay.
Yep.
Any sort of rent you'll need to pay. Anything else like professional memberships and stuff like that. And from there you work backwards in saying, and it's almost like setting a target. How many jobs do you need to get over the year to cover your expenses? What is your minimum? And it could give you, if you do land one big consulting job, how do you do that cash flow? Do you collect a deposit up front? Do you do it on milestone to cash flow your way through rather than wait to the end, rather than wait to completion to get a large lump sum paid in? So it's a way of thinking, planning out if you do have a longer term project to milestone the payments.
Cool. Okay, another question here. I hate following up on unpaid clients, especially right now when so many businesses are struggling with COVID. My clients are small biz. Do you have any suggestions?
There are apps available to assist you. Look, there's no one likes doing it. I've got to say, you've got to be a pretty special person to like it. Okay. I guess I know a lot of people's clients are struggling themselves, which means, and it's a perpetuating sort of spiral as well. If they're not paying you, you're going to start struggling and you're going to start struggling to pay your suppliers. So I guess it's a matter of making sure that you've done everything you're obliged to do under that arrangement for that monies to be owing. Don't be scared of entering into payment arrangements of some sort, but it does need to be documented. Taking people to small claims courts and whatnot doesn't always achieve anything. It's trying to find a mutually beneficial outcome for both parties. And if it means staging the payments out in some way, then that's going to be better than not collecting anything at all.
Yeah,
but
the
other thing is you need to keep in regular contact with that customer because, often I've seen it before, some retail shops just shut overnight and move out. So you need to at least have some sense that the business owing the money is still trading in some way. So you need to you need to stay on the ball with that stuff because it may mean you collect nothing at all.
Fair enough. Okay. Any other questions, anybody? Just whack them in the Q&A box. Just so everybody knows, Amy's part of the Business Connect program. So please, if you want some one-on-one sessions with people like Amy, it's free of charge. So go to either the website that you see in front of you, which is realize.business, or just Google New South Wales Business Connect. They've got a whole range of advisors which cover everything from marketing through to cash flow, IT, social media, et cetera, et cetera. So please go on there. It's free of charge. What you have nothing to lose by doing it and everything to gain. So please, I really encourage you to do that. Now, there are no more questions coming through, Amy, so I'll wrap up. So I just really want to thank you again for your session. Lots and lots of interesting information. We'll hope. Well, and thank you for everybody attending today. We'll see you all very soon. We've have this, so we're now half. No, sorry, we're not. We're somewhat through the program. We still have. We are halfway through. Sorry. So we have another 6 more sessions. So please visit our website. I look forward to seeing you at future events. Thanks, Amy.
Thank you.
See you, everyone. Bye bye.